Okay, thanks, Rick. Let's bring in our jobs panel again, Sarah, Ben, and Allison. But Steve, we just, how long ago were you sitting? You were sitting over here. That was today.
I was on the other side there then. So
no, I told you I was scared. I really was hoping for a really crappy number, and it's not so much that that I think that would mean more cuts or a likelihood of more cuts. I just think it would start to make you think that we don't have to worry about inflation so much. But when things like this are happening, inflation, which is already, and I'm not talking about tariffs necessarily, and I'm not talking about immigration necessarily, but add those in. But just where we are, just from what's remaining from what the Fed was trying to do in the first place. We weren't there yet when they started cutting. And it doesn't seem like we're there, and this doesn't seem like, and the markets do not like this. And there goes the 10-year and the 30-year. Why am I wrong?
Well, it's like you come home and your daughter kisses you and you say, I'm afraid you're not going to love me in the future. I mean, right now, Joe, you got really good job numbers.
You're just arguing. You're arguing with the markets.
I'm not. I'm just.
Why is it happening then?
I'm just saying.
Just talk about what is not.
First, you're right. You're right in the sense that the Fed had pushed aside this notion that employment was a potential source of inflation. These kind of numbers kind of bring it back in the sense that the payroll numbers themselves are hot. Unemployment rate has been, dancing around this 4.1, 4.2 number. But I don't want to awfulize this number, Joe. I just think it's the wrong way.
You don't have to.
I mean, the market can awfulize it all
What is
at
the
once.
market saying?
I don't think it's right to awfulize it, okay? I am going to argue with the market.
No cuts?
I'm going to put my hand down.
No cuts?
I think it's no cuts. I think that's right. But we're putting a lot of people to work. We reduced the number of long-term unemployed. We have a little room left to go
always like
on
jobs.
Participation.
There's always that argument.
Wages were not that hot.
We're talking about markets. There's always the argument that we do want people working. We want people getting great
let Wall Street tell me what the right number of employment is.
Depends on what the number. Let's get to.
It is a cynical perspective.
It is, but it's just we are
good. People have jobs.
We face what we face. Sarah, what are you? Are we over here? Are we seeing the kind of economic activity that would say yes, you were right, Jay Powell, to cut, and yes, we need to cut more?
Well, I think, first of all, when Jay first cut by 50 basis points in September, they might have been a little bit overly optimistic on the view that the employment markets were weakening, which obviously they're not. I think there's three factors that determine the path of the markets from here. That is, what does the Fed do? How much tighter do conditions get? And also market valuations. So starting with the Fed, we are already down from hoping for 4 rate cuts this year to 2, and I think today's number is going to take us well below 2 to 1.0, or maybe even talking about rate hikes. Tighter conditions are an issue for equity markets. These higher yields are a headwind for the markets, also stronger dollar, so that's also kind of a negative here, which is why the markets are down. And then let's talk about market valuations. We are currently trading at about 90% versus history in terms of a premium for the S&P 500. So what do we have to take us forward from here this year? We can't rely on valuation expansion. We're going to need to rely on earnings growth. And can we get that? We can probably get about 6 to 7% earnings growth on the S&P. That takes us for the bulls to about 6,400 on the S&P if everything works out just for earnings growth, which is basically, kind of what we have to rely on here because valuations are going to have a tough time expanding for the S&P.
Ben?
Yeah, so I think that the big number here is not the payroll number, which is coming in much hotter than a lot of analysts expected. But the big number here is the U3 and the U6. So seeing increased tightness in the labor market. This isn't just in isolation. We're on the cusp of a new administration. We're on the cusp of a new administration which has pledged a very different immigration policy than one we've seen for the past 4 years. So I think this makes the Fed's job harder. The Fed will have to, again, start worrying about wage price spirals and labor-driven inflation, particularly if we see out-migration in terms of immigration and a shrinking labor force. So, that's the real concern. I agree with Steve. Like, in the absence of that, this is probably good news. This is more jobs for Americans, rising wages. But there is a real concern about the labor market becoming too tight.
All right, Allison, from where you're sitting, what do you think?
I mean, I'm with Steve. This is, a good report. I mean, it might not be what the market wants, but, it means people have jobs. I'm starting to just think this is a healthy labor market, and we might have to come to terms with the fact that anyway, inflation isn't as low as the Fed would like. This might just be where inflation is and where our new equilibrium rate of inflation, which is bad news for the Fed, because I think they were very anxious to cut so they could tell the story that, oh, we've got inflation back down to target. We're
they
still
already
fully
cut. They
yeah,
already.
well, they want to keep cutting.
I know,
So
but they can make mistakes, Allison.
Yeah, I think that's right.
Go ahead, Allison.
Yeah.
Sorry.
Well, I think they were trying to tell the story. We beat inflation. We're credible. And now it looks like that last half mile isn't going anywhere. And I think there's a lot of inflationary pressure in the pike next year. Even if the Trump administration is successful, it'll boost growth and potentially inflation too. And then the Fed might be in a bad position of saying, we've never made our target. We were below target, then we were above target. But since we've had a target, when has inflation ever been two?
Allison, I don't. These things matter. Is I guess what I'm saying. And if we saw, and no one's saying we're going back to Jimmy Carter years, and we had a funeral yesterday, but it matters if you don't anticipate properly. Like when they stayed at zero too long, you can make the same mistake coming down too quickly, and that's what the market's, I think, thinking. Not just no cuts, but you really have. Could be they could be raising by the end of the year.
I think that's looking likely. I mean, I said, I think we're right that maybe one cut is the best case scenario. And I think, again, that's highly unlikely. I mean, unless, this would be worse, there's a big economic shock that causes a recession, then they'd probably cut. But I don't think anyone wants that.
The big story in this number, sorry, Beck, is the 231 in the private sector. So this is private sector job.
Private sector job growth. I'd love to bring Rick in.